Folks, we are back. It's Paul and Darren back for another month. You guys seem to love these conversations between Paul and I, and I have to say I'm enjoying it as well. There were some comments, though, from the last video that got Paul and I thinking a little bit. So toward the end of this video, we're going to address some of the comments that came up. That's the whole reason that Paul and I like this, is to engage with you guys. So Paul, welcome back. How you doing? How was your Christmas?
Darren, I can't believe it's already February, right? Like, where did January go?
So true. What's the snow like out there, by the way?
The snow is terrible. The cold is terrible. How was Mexico?
Yeah, Mexico was great. Not gonna lie, folks. That's if you're my audience, you'll see I missed a video. Yeah, I got to go to Mexico, so that's why I didn't get another one out. In fact, I had to edit the last video. Paul was giving me a hard time. I had to edit my last video, but also get Paul the video for the last video that we did. And I did it at the lounge at the airport at YBR in Vancouver. So
nice.
YouTubing takes you everywhere. You have to keep working no matter where you are. So yeah, no, it was great. But our weather is completely different out here. It's raining and 10. It's crazy.
Really?
Yeah.
No, it's cold here. With the wind chill factor, we get, between minus 25 and minus 30. And I don't know about you, Darren, but the older I get, the more I dislike winter. And the more I like summer. But you probably know Sean and I and the wives are going to Costa Rica in about 12 days from now. So I'm looking forward to that.
I'm totally jealous. That is for sure. All right, let's talk about investing, because that's what everybody's here to listen to, not us romping around in the sun, although that's fun.
That's why we invest.
That's right.
Right.
Pick a plan, stick to the plan. So I just did my year-end wrap-up, and then I just did my month-end. And before we came on to record, Paul and I were chatting a little bit. And, once a year, I rebalance my portfolio. And I know Paul's been chatting about that. Maybe tell us a little bit, Paul, about what's going to go on with your portfolio this year, sort of the global sense.
So this year, what I want to do is take a more defensive position. I think we talked about that before. So I've actually implemented Perry's pillar strategy into my portfolio, where I've divided up all my holdings into his anchors, boosters, and juicers, and realized that I was really low on the anchors. So I haven't made my video yet for January for like a month-end review, but I've kind of sat down and started working on it and kind of picked which anchors I want to focus on buying in February. So that's what I'm doing, trying to build up my foundational, like my core positions, the ones that I can count on, right? Like, for example, I know we're going to talk about HDIV eventually. So positions like HDIV, for me on the US side, I'm buying TDAC, which has the NASDAQ. I'm buying Canny on the Canadian side, stuff like that, just to be more conservative. I don't know if I'm going to sell any holdings in February because I actually kind of like the ones I have at the moment. There's a few that if they skyrocket, I might take the profits and sell them. Some of the individual stocks, right? Some of the ones, not stocks, but the covered call ETFs that have just an individual stock as the underlying. If any of them really shoot up and I can, capture 15, 20 or 30% gains, I might get rid of them just to streamline my portfolio. That's what I'm thinking about doing.
That's what I did at my year end. It's a good point, is to rebalance your portfolio. Gives you a chance to sort of revisit things, maybe look a little more in depth into each position. In general, for me, rebalancing is just simply the ones, as you just described, that have done fairly well, and then rebalancing into ones perhaps that aren't performing as well. If a position has grown, as you described, a little bit higher, you're just naturally going to want to put that into one that maybe is, in the red, we'll call it. I just went through that in my portfolio. And one of the big decisions, if you didn't watch that video, was that I have thought a lot since Paul and I have been talking about cover calls. I'm not gonna lie, the skepticism does exist long term, but short term, I think I see some merit. But for me, I still have quite a few years. Like, we're talking, maybe 7 more years before we actually retire. And who knows, I've been doing a lot of planning for when we start taking money out, because I have a pension. As it turns out, I haven't talked about this before, but I actually have a secondary pension. It's super small. It's going to work out to I just looked at it yesterday, like $300 a month. So previous to my current job, I employed somewhere else and I have a small pension. So looking at how to maximize, how to take it out, sort of been what I've been looking at the most recently. And then within that, I decided, you know what? these covered calls, they would make so much more sense if I was in the shoes where I need that income now rather than seeing some of the growth. I don't, whether the growth comes from the dividends or distributions or the growth in the fund, to me, it doesn't really matter when I'm still accumulating. So I went and I got rid of a bunch of positions that in the covered call space. The primary one, which you just mentioned, is a single stock. So I had TSLY and I held it in 2 different accounts, and it performs well. Obviously, Tesla is very volatile, so it's not like it was in the red. Like I didn't see it not performing well, but I hold Tesla as well, and then I also hold VOO, which holds Tesla, and I also have XEQT, which also has Tesla in it. So to me, it didn't make sense to have those cover calls right now. Now, when we retire and we're not accumulating anymore, yeah, maybe that makes more sense. And then obviously choosing between, is it a single stock or is it an ETF that has a bunch of different ones? Like for instance, HHIS, very concentrated version of how many positions is it now? Like 19, yeah. So you're increasing your risk in that fund because it's concentrated. But that would be like the same as like the NASDAQ versus the S&P 500, much more concentrated. So you're increasing your risk. So that was sort of the focus for me with my portfolio. So I jumped up quite a bit, and I realized I forgot to really point it out in the video because I often show on the distributions and dividends, how they're increasing and stuff. And one thing to keep in mind is when you drop covered calls or income funds, your distributions and dividends will shrink. So I have funds that pay out once a year or half a year. Once a year, half a year, quarterly, and then monthly. Well, obviously that's going to impact the monthly distribution. So I'm alive to that. So that's definitely going to happen. But I had the big payout at the end of the year. It was like $2,000, just above $2,000 in distributions because 2 of the funds paid out that particular month. So I jumped up about 20,000 in the portfolio, but that's because I got those distributions in that particular month. And then, as you know, Paul, this last little bit's been pretty bumpy, right? Like the portfolio's been hit pretty hard based on the way the markets are. Yeah.
Oh, mine has. I know I was talking to some other YouTubers, and I looked at some of their positions. I think you have VFE. And maybe VDY. And on Friday, I think VFE was actually up 0.9%, right? And VDY was only down 0.5%, where my whole portfolio was down like 3%. So you can see the big difference between, I guess, something like a VFV that holds the whole S&P 500.
I actually hold XEI. I did hold VDY at one point, but I had them both. So I sold VDY and I hold XEI. And I would hazard a guess, I could probably do a video on it. I did do a video on it a long time ago, but with a bit more knowledge, I think I'm going to do another one where I talk a little bit about the nuances. But some of these funds, the MERs being very similar and the what they're tracking is very similar. So the returns are such that if you're into one, there's no point in switching from one to the other just for like a small percentage change. To me, that doesn't really make a lot of sense. And so, yes, you're hitting on one of the things that was key for me was which covered calls do I own? How much of the portfolio does it make up? I had said that I wanted to do 20%. Not gonna lie, I got a little nervous when I saw how much it was growing. I had roughly 57,000, and the cover calls I chose kind of mirror the rest of my portfolio on the growth side. That's kind of how I chose them. But yeah, I got a little nervous. I was like, if we're seeing some corrections, what's going to happen to these funds? Now, I am very alive to your realized gains or losses are only done once you sell. So if I sell a position, then I'm realizing it. But for now, that's not what's going on. But it, psychologically, you look at your portfolio and you're like, it dropped a lot. So I dialed that back to 10%. And I think that's a fairly reasonable number. 10%, it's just under, I think it's like $45,000 in total. But as I add more, that will grow as a percentage, right? So that was kind of my mindset. I'll do 90% in growth. And by the way, there's some REITs in there. So I guess you're technically not really growth. And then obviously I have some cover calls. So I think that hybrid approach is working fairly well. The only fund for me that's really taken a kick, which I just mentioned, is HHIS. It's down, like my biggest holding is in one of our accounts is like $12,000. And that's down, was almost down 2,000 as of yesterday. But the markets rallied this morning. I don't know, were you looking at that, Paul?
I was looking at it. It was red. First thing was red. Then it started turning green a little bit. And then I just got busy doing other stuff. So I haven't checked it recently. But now, did you sell some HHIS? Why don't you tell us which covered call ETFs you sold so I can mock you? I mean,
I did up this spreadsheet in my last video so that I could show people what I had sold if they were interested. Again, this is important. We're not financial advisors. We're just sharing our journey and the things that we do. And if you get something from that, I think that's great. I kind of, I reframed it in my last video. I kind of like to think we're helping you establish some foundation, but there's so many things out there that you could buy to research and sell and so on and so forth. So don't just take it at face value what we're doing. This is just what we do, or in this case, what I do. Your question was, did I sell any HHIS? I did. I reduced. So in my TFSA, you can see here that I reduced my HHIS position by about 1,500, USCL by about 1,000, QQC 426, and then I sold off all the Tesla. And what I did with that was I reinvested it all back into the Canadian market, into XIC. And the reason I did that is it seems like the American economy is not as strong as the Canadian economy. And I think they kind of go in ebbs and flows. And so that was sort of the premise behind it. Was also, I use the Ben Felix approach to making up the asset allocation. So in my TFSA, when I originally built it, I used that framework. And now with XEQT, because it does the same thing, the framework is basically the same within them. If I'm adding money to an account, I'm using the framework that I built. And if it's an account where I'm not, then I'm just using XEQT. So in my TFSA, the Canadian exposure is through XIC. The rest of it is international and so on and so forth. There's, small cap and whatnot. So that's why I did that. And then let's see, as far as the other cover calls, so YTSL was the other one, and I had that in my wife's RSP. So I sold off all of that, 4,500, HHIS, sold off about 2,800. Now, I'll say this because you're probably wondering, even Paul, when you're sitting there listening to me say this, I had a higher amount in HHIS than in the anchors that you just mentioned. And whether I realized it or not, I think I'm just realizing this now with the terminology that you used. By having a higher percentage, I felt in HH, I was taking more risk. And it's very obvious that it reacts differently to market conditions. I didn't think holding a higher percentage of HHIS was a smart move. I think it would have been better to have the anchors that you're talking about. So yeah, so I did sell off a bunch there. You can see USCL, HYLD, and then that was reinvested into XEQT. You can see that the vast majority of it went into XEQT. And yeah, as far as cover calls go, those were the big ones. And then you can see I sold off like a little bit of Tesla, a little bit of Google. I sold off all my VTI. So in one of my previous videos, maybe 3-4 months ago, I had put VTI in, VTI being the whole US market.
Okay.
My thought process was I wanted to be more diversified outside of holding VOO. But, some people were like, well, you have a lot of overlap now. I think the better way to do it would have been to sell off the VOO and, buy into VTI. But that has to be a really long-term play. And I'm not sure that I have that much time. So I decided to just stick with my VOO position.
I got a question for you, Darren.
You bet.
Okay, so when you were sort of picking and choosing which of your covered call ETFs that you were going to sell, was there like a method? Did you look at the share price at the time, whether you had a capital gain or a capital loss or anything, or you just, all right, I'm going to get rid of these, sell them now?
Obviously, it would be best to do that. But at my 1-year rebalance, my whole thought process, I only do this once a year where I do a bunch of this, is, hey, like I have a larger portion of whatever, and I'm going to turn that around and put it into something else that I think might produce. So the XIC example is a good one. So I think the Canadian market is stronger right now. It'll probably perform better over the next year. That's more of my thought. So no, I didn't take the time to evaluate that. However, generally I do. I'll look at positions and determine, and the best example with the cover calls that I can give is, or income funds, is if I see the positions down, say $500 or $600, I'll look at the amount of distributions I made. I guess it's more of a psychological game and determine, hey, with all of that, I'm actually broken even or I'm up on that position, and I'll make the decision to sell in that regard if it happens to be throughout the year. But the one thing I'll say is like I don't see myself adding or taking away positions in that space unless I realize like, oh, like this is a really good fund to have in here. I think the funds that I have right now fit some of these anchor ideas. I think HHIS is maybe a bit of a risk play a little bit, like you have play money. I think that's what I'm doing there. So no, I didn't do it that way for my year-end balance, but good question.
Yeah. Well, I think what you just described is smart too, though. If you add up the distributions, right, then you know what the total return is. And a lot of times I'll look at a position and I might be down $1,000, but it's paid me $2,000 in dividends. So technically I'm actually up $1,000. So then I don't feel bad selling it, right? Then it's not really a loss.
Yeah, 100%. I think that's that psychological aspect. And that's, I think, the thing I learned more about cover calls or income funds is there's a lot of psychology in those funds. Like, as well as I do now, you're adding XEQT, pretty plain Jane, vanilla approach, throw your money in, it grows. Every quarter, you're going to make, 1.5% return. But for that fund, that's not what you're looking for. And actually, I ought to throw that one out to you.
I think if I saw on your chart you sold YTSL at about $25 a share, I wish you had it sold it. I think in December it hit 29.
Yeah, it doesn't really matter. You're still up. The one thing I notice about my portfolio is the ups and downs. Like if someone says like, well, this week, like your portfolio's down a lot, but it could bounce back and it's not realized. So really it doesn't really matter. It grew to get to that point. You just missed the 29 versus the 26.
Yeah.
You know what I mean? Like you could have bought in, your average price might be, we'll call it 20. You're still making money. So I guess from that perspective, if you wanted to microanalyze it, then yes, it would be obviously ideal to have done it in December, but that's not really the purpose behind it. So
yeah. And the bigger your portfolio is, the bigger the swings are going to seem, even though percentage wise, it's the same, right? Because if you have $1,000 portfolio and somebody else has $1 million portfolio, and both your portfolios drop by 10%, his is going to drop by $100,000 and yours is going to drop by 10,000, but it's still the same percentage, right? So I think
that's where I was going with my thought process was you're still getting all the distributions, even though you're down, whatever it is, $16,000 and I'm maybe only down 2 or 3. You just have to ride that out. And that's hard for some people. If you can't stomach that, if you look at your portfolio and you're like, oh my gosh, then maybe that's not the right thing for you. Like maybe you should find something a bit safer. And the other thing too, I was thinking about this because I've been thinking about like, what are we going to do when we retire? But you don't have a need to take that money out. What I mean by that is your distributions are covering your $1,000 withdrawal every month. So you don't need to sell those shares in order to get that capital back. Now,
that's right.
When you really start to draw down on your portfolio, that could change.
Yeah, and you know what, Darren? I decided for my end of January case study video to ask AI, what does it think of my case study? So I fed it as much information as I could just off the top of my head, telling it, I have a TFSA, it's holding these positions. And I told it exactly what ETFs I have and that, I make $1,300 to $1,600 a month in distributions. And I'm withdrawing 1,000, is this sustainable? And I'm not going to tell you what AI said, but you're going to have to watch the video. But I thought it was an interesting project, I guess you want to call it, just to see what AI thinks about my video. It was funny. It gave me 2 different scenarios. And in the one scenario, it referenced Perry's pillars.
That's interesting.
Isn't that fun?
I use AI to do my research and stuff like that. I help it build me scripts or ideas and stuff. But I'll tell you something, like, I'll bet you when I say, for all of these that don't know, in the video description, there are links to a lot of the different platforms that we use and stuff like that. So don't forget to check those out. But the one that I like to talk about is the buy me a coffee, because it literally, like, I could spend hours researching something because AI might tell me something and I go, oh, that doesn't make any sense. And then I'll actually have to go reference the actual material because you can see what it referenced. So I bet you it's referenced Perry's YouTube channel, which is kind of interesting.
Well, I think I've asked it before in the past to make me descriptions of videos that I've done with Perry, right? And about the pillars. So I wonder if it actually remembers or...
Yeah, AI does. It will remember what you told it to do. Now, sometimes, of course, it's not perfect, but yeah, it does. And I think it depends on if you're paying for the subscription and stuff too, obviously. But yeah, I
Right.
find AI kind of interesting. And I do ask it stuff like that. Before we started recording, we were talking about taxes. And I've been talking to it about various taxes things. So I'll ask it a question, and then I'll go reference that material from the CRA to make sure that they match.
Yeah, it's amazing. It really is. And I think, Darren, we'll get into the comments and questions part of this video. But before we do, one of the mistakes I've been making recently, I think, is trying to compare my portfolio to somebody like you who's more of a growth investor, right? And then, but I'm looking through it as a growth investor through that lens. And then I'm disappointed. And it's like, wow, my portfolio doesn't seem to be performing the way that it should. It's an income portfolio. It's not designed for growth, right? Growth is nice. Like, I would like to see the portfolio balance grow, but that's not really what it's designed for. So when we get to the end of the video, I'll explain more about that. And just, I think it is doing exactly what it's supposed to be doing.
And I hit on that in the last couple of videos that you and I have done, that initially I thought it was going to be an interesting experiment, but the money, the size of the portfolio and the style or the way we're using them they don't match in the same regard. But the principles, I think they do. And you mentioned anchors, and I think these are the things that people love for us to discuss. We're kind of learning. This is, I call it the You of Blossom, but you're seeing us learn kind of live as Paul and I chat together and we learn more. And I think those principles are more important than what you invest in. In fact, I would also argue, and I've talked about this recently, is a lot of people get caught up in what they invest in, but the reality is, like in your case right now, you needed it to design, or you needed your portfolio to provide you with a steady flow of cash, whether you got that from selling shares or the income from these income funds. My portfolio, I want it to continue to grow. And those two different styles they're totally different. You can't compare them in any way, shape, or form. And so that wasn't a very fair comparison. But like I said, we're building some foundational pieces from all this.
Even if you're, say, for example, a growth investor, you still have to have anchors, right? But your anchors would be different. Most people in the States pick VU, right? Say VU is a big anchor, or VFV in Canada, or now XEQT, right? Or other versions of XEQT. So that's a perfect anchor for a growth investor. Whether you make it 50% of your portfolio or 80%, and then do like you're doing, where you have 10%. Some people do single stocks. Some people do income, Bitcoin, crypto.
One other point I meant to make is that if you're in your shoes, you're not really adding anything to portfolio. It's basically a snowball on its own within the portfolio. But if you are someone that is still making contributions and you're still growing the portfolio by adding money to it, that's why they can't be compared similarly. What's keeping mine afloat as far as the markets go is the contributions that I'm making. It's not the growth. I've had some comments about that where people are saying, well, it's not fair to say that your portfolio has grown a lot, because I say, in my intro that I'm building wealth because I'm older. I believe that. I believe I'm building something that I never had before, and I like to point that out. But I'm also very alive that these large contributions that I'm making are what is sort of giving momentum to the portfolio as well. But again, I think that's a foundational piece. Even if you're older like us, it still works. But if you're young, you have more time to make that over a longer period of time.
Yeah, for sure. Do you plan on matching your 2025 contributions this year? Do you think you're going to go that hard or ease off the gas a little bit?
I mean, we'll see. I said it in the video. It was not easy. There was a lot of extra shifts worked, and to try and get the portfolio to where I need it to be. One of the interesting things I learned from the calculator that I used is if I was just to leave the portfolio and add nothing more to it, as far as the basics go of what we needed for retirement, we would get there in that 7 years. But that's not what I want to do. I want to keep the momentum going because I realize there's more to it. We have kids. So the RESP we have, because we didn't invest that when they were young either, it's growing, but they're going to need more than that. When we're 60, they're going to be 18 and 19. They're going to need stuff for school. And then, if it God forbid the day came where Lori and I weren't here anymore, that will be legacy money for them. So it's pre-planning for our kids as well. I've got set contributions. And I don't know about you, Paul, but automation for me is a huge deal. Like if I know that money is gone, like it's set up, it's going in, that's good with me. Then I don't even think about it. Which reminds me, before we get on to questions, your margin account. What's going on in there?
So the margin account is doing really well. I finally got it up to $10,000, which means I've borrowed $10,000. I have 6 funds now, and they all seem to be doing fairly well because they're all anchors. Yeah, my margin account, I'm not being risky with it. I'm not buying any HHIS booster type, ETFs or any juicers, right? I'm not going for, like MSTE or anything of that nature. So it's doing well. Now, last week, say Monday, Tuesday or whatever, the account was up quite a bit. By Thursday, Friday, the whole market tanked, right? So it did drop a little bit, but it's still in the green. I'm going to get paid this week. So I ended up paying about $30 in interest, but I should get about 120 or 125 in dividends. So I think it'll pay back the interest, and then it'll help pay down some of the margin. Can't even speak. Some of the margin loan.
So are you taking your distributions and then paying down the interest from there, or do you pay it out of your other accounts?
It's automatic. It's automatic.
It happens automatically.
Yeah. It's so in your TFSA or your RSP or whatever account you have, unless you set it for drip, when you get the dividends, they put the money in your RSP account as cash. And then you could leave it there for years if you wanted, or you can pick and choose what you want to buy with the money. In my margin account, they never deposit cash there. They automatically pay that interest. So they get their interest money first. And then I think they just pay down whatever margin loan you have. They put the distributions towards that, which is fine.
So you're paying them the loan down at the same time.
That's right.
Okay.
Yeah. But I don't have to make when you borrow money to buy a house, which basically it's like margin, right? You put a down payment, you borrow money, but every month you have to make a mortgage payment, or weekly or biweekly, however you choose, right? With the margin account, I don't have to make any payments to pay down the margin. The dividends are doing that for me.
Right.
Yeah.
Have you ever thought about the whole Smith maneuver idea? And I don't mean it traditional sense. I just simply mean like getting a HELOC on your house, because then it's your capital and not margin.
Yeah. We actually, when we remortgaged our house a couple of years ago, we did get like a HELOC. So I think we have access to $50,000 or $55,000 or something. And every time we make a mortgage payment, it grows. The amount that we can borrow grows. But I've never used it. I've never touched it. I've never taken any of the money to invest. It just sits there.
So in that regard, if you're using margin, you're borrowing someone else's money. But when you do it, what I just described, you take the HELOC, which is readvanceable, put it in a margin and invest it. And the audience can help if I'm not getting this quite right, but I think I have it right. Now that's your money. It's your equity. The equity in your home is working for you now, and you're not borrowing it from someone else.
I think what I have is maybe a high interest line of credit or a home equity, but that's a HELOC, right? Home equity line of credit.
There's
right?
2 different kinds. Again, audience members, jump in if you want. I wish this was live where you guys could just blast the comments at us. But so there's 2 types of lines of credit. You can get one backed or unbacked, I guess, a line of credit. That's when you get your mortgage. So we have one of those. And then you can also get the readvanceable HELOC against your home. So every time you make a mortgage payment, the principal gets forwarded to the HELOC, and then you can take that amount and then invest it. That's how the Smith maneuver works. All the money that's sitting in your home can be used. So instead of being mortgage debt, now it's a loan debt, for lack of a better term, but the interest can be written off. That's the difference. And it's your money. So anyway, something to think about.
I think you might be able to write off the margin interest as well, as long as you're investing in Canadian equities.
Okay.
I still have to find out. I mean, the amount of money that I've made and the amount of money that I've paid in interest is pretty small. It's pretty negligible, but I need to find out, like say I did it on a larger scale.
Yeah.
Pretty sure you can write it off because it's not in your RSP. It's not in a TFSA. You're borrowing money to buy stocks.
Yeah. Yeah, that's an interesting one. I'll have to look into that because I don't know the answer to that one. But if you guys do, leave it in the comments because we always like to know. Let's jump into a few comments and see if we can answer those.
I'll read one first. This one I don't think we really have to. It's not really a question. It's just a comment. Anyways, I get a lot of these. I think Darren gets quite a few as well. But this person said, I really enjoy your conversation about your investing experience. It is really motivating and knowledgeable for me in my early investing journey. So
and that's
I'm
from,
just glad.
I might get this wrong. High up Tran, that one?
Yes.
Hopefully I didn't say that wrong, High up.
Yeah. I just wanted to acknowledge the fact that we get a lot of comments that are really encouraging and, people thanking us for our conversations. And the thing is that before I started my YouTube channel, that's basically what I was doing. I was watching guys like, Robin Haney and Adriano and Candace, and all the other Canadian content creators, and they were keeping me motivated for my investing journey. And now I feel like we have the opportunity to give back and do the same for other people.
I'm very much with you there, Paul. I have to say, we don't always get positive comments. That's the nature of the game. People will disagree, but I can't tell you how motivating it is.
Read the one below, Darren. That was the next comment I was going to read.
Sure, from Greg Palmer, 6'7".
Yeah.
Hopefully I got that right. Perhaps it's not the crypto, chill or crypto. Winter, but the beginning of the crypto collapse. Yikes. Imagine that.
I was wondering, what are your thoughts on that? Do you really think that crypto is collapsing? Like crypto's going to go away?
No, I don't think crypto's going to go away, but I am no expert. I did examine the trend of crypto. Here's the trend from 2014 to today. It doesn't look like it's going to go away. If you look at all these peaks and troughs, there's just it happens like any market reactions, right? And I think that we saw that it got really high. People got nervous.
Yeah, no, I think so as well. And I think in my mind, Bitcoin seems to be sort of like the new technical version of gold or silver, right? Where people see it as a store of value or a hedge against inflation or a hedge against, I guess, fiat currency, but it's going to have its swings up and down. And who knows how much of that is being manipulated, right? The question I was asking yesterday was, how low is it going to go before, the big players, the hedge funds and, so on, decide to start buying Bitcoin again?
Yeah, that's actually a great point. These are things I don't think anybody really has the answer to.
I heard silver dropped like 33%.
Yeah,
I'm not sure how much gold dropped.
Definitely some big changes there for sure.
Yeah. And I feel bad for people who were buying silver. I don't know exactly how high it got. I think it broke 100 US, right?
I don't actually know what its prices were, but I believe it.
I feel bad for people who are buying silver or gold at their peaks, and then all of a sudden the next day it drops 20, 30%. I mean, if they hold, they'll probably be fine, right? Because who knows, maybe in 6 months from now, gold hits $6,000. But if you bought it and it dropped 30% the next day, a lot of people will panic and sell.
Imagine so I have 7 more years before I retire. Let's say I'm in that last 2 years and my portfolio is not maybe huge where I know that I'm going to be living in the lap of luxury. I got to make this money last until I'm 80, 90 or whatever age. And all of a sudden this holding starts dropping like crazy. I can see why people might react like that, but that's why actually you and I have talked about it. Having that cash wedge of some sort, however you want to make that work, is so important as you get closer to retirement, because then you don't have to worry about that. If 5% of your portfolio is in, let's say, Bitcoin, and it's dropping like crazy, the other huge part of your portfolio will make up for that. That's why diversification is important. And then you can just let it ride out and it'll eventually correct itself. What do you think?
Yeah, no, exactly. And you have to have, I think, multiple streams of income. You can't just depend or rely on one thing. I mean, when you get closer to retiring, you and your wife, if you choose, could probably tap into your Canada pension plan as well, right? Or you can put it off until you need it. You know what I mean? If maybe when you're 62, 63, you feel like you're a little bit tight on funds, there you go. You got your Canada pension plan. You can always downsize, you know what I mean? If you decide somewhere down the road you don't need the large house anymore, you can go to a smaller home or a condo. Like you have to plan ahead and have some options available.
This year is going to be a big part of maybe some of the videos I do is so OAS and CPP. These things can be deferred in order to collect more. I have a pension where some people don't. They're going to rely on their portfolio. So when people say that DIY investing is sort of the big thing or the rage, I do see a financial planner, and that's some of the stuff that I've learned. Life insurance, having a will. There's so many things beyond what you actually invest in. I mean, it's great that we have this channel. in these videos that we're doing where we're sharing what we're investing in. But if you don't figure out how to take your money out properly when you retire, the tax man could take a lot of what you made. So that's important.
Yeah. And I think, there's so much content on YouTube, Darren, and there's so many videos like ours, and people kind of maybe grab a little snippet here and there and learn something. But honestly, I just started rereading 30 years later, The Wealthy Barber. And
Yep.
even though I'm kind of established in most of those areas, he really does touch on everything, from paying yourself first, like you said, automate it, just set up an automatic, whatever contribution is. If you have a car payment, you pay it every month, right? You have a
That's
cell
right.
phone bill, you pay it every month. So why not set aside $200 or $300 or whatever amount and pay yourself? Right? And then he explains ETFs, index funds, but he also goes into things like insurance, life insurance, maybe health insurance, mortgages. So for anybody who feels like they are not where they want to be financially, I highly recommend his new book. I should try to get a sponsorship from him. I'm thinking about doing a Wealthy Barber Wednesday video, once a week. I don't know if there's a copyright infringement or something if I talk about his book online.
I've been listening to lots. In fact, I ran out of my Spotify subscription only has so many audiobook hours, and I burned them all up this month. I might get the title wrong. I believe it's A Casual Walk Down Wall Street. I might have the casual part wrong, but that one was absolutely amazing. And just like The Wealthy Barber covers so many of these topics, it's not just focused on what you invest in. And the one I'm listening to now is a Canadian one. It's I believe it's 30% rule. I should have had that prepared. But needless to say, listening to all these makes me think so much more about all the other important things. We took care of our life insurance this year. That was part of my financial planning session. We got our wills updated. Those are all really important because I don't want the government to take my money, because if you don't have a will, then the government's going to swoop in and divvy up your money, and you don't want that. You want it to go to someone important in your family.
I was just going to say, there's a lot of little things you can do, and they're not necessarily that complicated, but if you just do them one by one, you can make your life financially stable, and it's pretty simple. I started reading, I think it was The Intelligent Investor, right? Yeah. That's a complicated book, right? It's a difficult book, and I'm reading another book about Warren Buffett, and I love Warren Buffett, but that book will put you to sleep in minutes. It's boring as can be. But The Wealthy Barber is such an easy read. You know what I mean? That you can bang out a couple chapters a day and learn everything you literally need to know about investing. And it's not going to teach you how to pick the right stocks. That's not the point of the book. He makes that pretty simple. Just invest in the S&P 500. You don't have to worry about anything else, and you'll do well. Yeah, I have so true. I have another comment. I don't know if you have some as well, but I'll read this one first, and then we can get on to another one. This person, I don't know if you have it there. I think you do. Is it CC ETF Investor?
Yeah, got it right here.
So he said, great conversation. Good to note that announced returns exclude fees, and good fund management and cheaper leverage is worth paying for. So I think he hits on a couple of things there, right? One that people might not understand is that if you're an income investor, all of the distributions are net of fees, right? They exclude fees. So we know there are fees involved, and you should understand them and why they're there and what you're paying for. But don't think that, your 25-cent monthly distribution is going to be before fees, right? In other words, they're going to deduct fees from that. Also, good fund management is, I think we've realized in the last couple of years, there's some good fund managers and there's some bad ones. To be fair, I don't necessarily know if there's bad ones, but I think the way they've designed their products are not for the average person. And I'm talking about Yield Max, right? Seeing how Yield Max has crashed and burned hard. So for people who thought these were long-term investments, have been hurt, I think, pretty badly, and myself included.
That's a good point, and maybe something to emphasize as far as yield. That's always the big topic is, oh, wow, like look at the yield on this. I mean, we hear it all the time. On Blossom, you'll see people not criticizing, but pointing out like, hey, so I agree, Paul. It's like car dealerships. That's the way I like to put it, is like each car dealership's going to try and sell you their product only to make money.
Yeah. Yeah. So, and then his last point is that cheaper leverage is worth paying for. And I know, people look at the fees, say, Harvest might be charging a 2% MER, but look at, I'm paying Wealthsimple 4.45% in order to borrow money right, in my margin account. So I'm willing to pay 4.45. Why wouldn't I be willing to pay a 2% fee for them to do it for me? I don't know if that makes sense. I don't know if that makes sense to anybody else, but in my mind, it makes sense. Yeah. So, so I thought that was a good comment from CC ETF Investor. Well, I guess that's
Yes.
covered call ETF Investor.
I'll jump over to mine. First of all, I want to start off with this guy right here. What's his name? Robin Haney. So if you guys don't know Robin, he's a YouTuber. He's definitely somebody that I started following when I started. And on the comments section from the last video that Paul and I did, he jumped in there and provided some of his feedback because he does have margin like you do. And I think that's great. He has a fantastic system that he developed with his margin account. So check his channel out. He talks about it there, much like Paul does. So I thought that was pretty cool that he would jump on there because effectively, when Paul and I were talking on this video, we were talking about the higher MERs. I had asked the question, is it worth it? And obviously there was a lot of opinions and Robin had expressed his. So I do appreciate that kind of thing. So, here's that comment that I was mentioning. So from Raymond Hobbs. Hope we got that all right, Raymond. Thanks for dropping your comment. It says, your videos have motivated me to reinvest at 74 instead of being static. I certainly have learned a ton. And of course, this is Paul and I working together on this project. So when you see comments on my channel, because Paul does post it on his, I take that as a compliment to both of us for the information we put out. So Raymond, I'm happy to hear that we were able to give you a bit of motivation.
Yeah, I think I got a comment on one of my videos, and the gentleman was actually 77 years old. And he made the comment that you're never too old to learn. And it's true, you know what I mean? And actually, if you keep learning, your brain will function far longer, right, than if you do nothing. So it's awesome. I love getting posts from people, either like, say, for him being 77, or somebody posting a comment and they're in like Australia. Like, I can't believe somebody in Australia is watching our videos. It's amazing.
In our analytics, we can see what countries people are watching from and stuff. And yeah, as your channel grows, the reach is crazy. But again, I love the fact that we can provide some foundational pieces and motivation to others. This guy here, he also loved things that was, or maybe it was a gal, I might not pronounce that right. Analsk. I love the videos you two put out. Please don't stop. We really appreciate that. It's motivating, when you think about what 25 and Invested said. So his name is Rain. He also has a channel, and he was commenting because I talked about, making YouTube videos, how much work goes into it. Paul, you talked about in one of your videos about how much you've made. You have to look at it as a passion project. And if it turns into a business, that's great. And even he comments, because he makes videos, that you're delusional if you think that it's easy. Appreciate that, Rain. Now this one here is, I think, what really kind of got me thinking a little bit about the comments that I made. Not this one in particular, but there were a few comments like this. But this one is from Ronan Arson 6342. Hopefully I didn't get that wrong. So you have to remember that the MER is higher on HDIV because there is 25% leverage, which is included in the MER. Look at the total return, and HDIV beats the TSX. HYLD outperforms the S&P. I had compared HDIV to XEQT. My whole motivation for that was to show the wider audience that you need to consider the fees themselves. That was kind of the point I was trying to make. But the comments I'm getting are, you compared it against the wrong thing. Paul, what do you think?
Yeah, that's a tough one, I guess. But I think the point is that you do have to look at total return, right, when you're comparing these ETFs. And sometimes they're not identical, right? Like, it's hard to sometimes find the exact comparison to, say, an HYLD, because it's not exactly the S&P 500, right? I know Adriano does a lot of these type of comparisons, where he has certain funds that he likes to use to compare against HDIV or HYLD. And at point in times they are outperforming, and then other times they might underperform a little bit.
The lesson I took away from that was when I'm thinking, and I did comment on it, is when I make these videos, again, not being a professional, not having letters behind my name, I don't want to steer people in the wrong direction. I want to highlight certain things, and you can take it for what it's worth. So in this case, I did do some research looking at HDIV, comparing it against one of the benchmarks was XIU. That was the one that someone suggested I should be looking at. And I agree that net of total return. So if the total returns of whatever the fund is outperforming and outpacing, that's ultimately what you want. I agree with that. But my question was more geared towards, is it worth it in the long run? Well, that's an individual thing. Everybody is going to see that slightly differently. However, I do appreciate that people took the time to both watch and leave some meaningful comments to create. Like, I spent a lot of time researching this after the fact, looking at the funds. And the one thing, my big takeaway, and maybe Paul, you can help me out, because the one thing I'll say about Paul is Paul seems to understand these cover calls really, really well, where my strategy is pretty boring. I don't need to understand much more about XEQT than what's inside it and how much to invest in it and stuff like that. But the makeup of some of these funds, so HDIV, for instance, is made up of a bunch of other Hamilton funds. So my research tells me, like, you have to really drill down inside some of these funds to find out what's going on. And I know in my last video, you mentioned HYLD is on, I think it's on 3.0 now, right?
Yeah. Yeah. They keep changing the holdings.
Yeah. So, and they do that. That's what you're paying for. And it's also important to know that there's a difference between the management fee and the management expense ratio. The management fee on the fund might be less than what the management expense ratio is, because that's inclusive of other fees. So
in a way, when you think about it, HDIV and XEQT are kind of similar because they both hold other funds, right? XEQT itself is nothing, right? XEQT just holds, I think, 5 BlackRock or iShare ETFs.
Yeah, that's right. So here's HDIV on the screen, like 9 different Hamilton funds within it. So if you really want to drill down, you have to go into each one of those to see the fees. This is a multi-sector fund. So from that perspective, that's a good thing, right?
For sure. Yeah, it's kind of like XEQT, right? So instead of you picking and choosing which Hamilton funds you want to buy and how much to hold of each one or which ones to buy, just pick something like HDIV, and you're not going to get the highest yield, but it seems to have been a consistent yield and an increasing distribution with some capital appreciation, and put that all together and you got a winner.
So let's drill down on that a little bit. Anchors. I'll be honest, I don't know all of Perry's pillars, although I did reach out to Perry and I would like to have Perry come on. I think that might be an interesting subject for Perry to talk about, is the pillars themselves and how he sees them from his investing lens. Now, this fund is, like you said, it's 25% leverage, right?
It should be.
And has some capital appreciation in stock price. And then obviously you're getting your distributions based on the cover calls that are written. So I would consider this to be an anchor, yes?
It is an anchor. And actually, I got to correct myself, Darren. HDIV is interesting because of the 7 or 8 funds that it holds, some of the funds in there are not even covered call ETFs. I think they're purely growth funds.
Yeah, that's correct. I was looking at them last night. For instance, the first one, Hamilton's Enhanced Canadian, I think that's FinCals. It must be short, but I think it's financials is what it's supposed to say. It's not. Like, some of them are not covered calls.
That's right. And I think that's some of those ones there, like that one, because banks have done so well in 2025. It's part of the reason why this fund has done really well. Yeah. So some of the ETFs actually are not leveraged, I believe, and some of them are not even covered calls. But putting them all together just seems to work really well.
And that's why all-in-one funds do well, whether they're growth or not. You get diversification, right?
Yeah. And so with Perry's pillars, I mean, you should wait till you have him on so you can explain it to your audience. But with his pillars, basically he just set up the start of a system that you can take and then you can make it your own, right? Like he made suggestions of having your anchors, boosters, and juicers. But I spoke to another gentleman from Blossom. He just wanted to have a chat, and he had a pretty impressive, I think him and his wife had a portfolio almost $3 million. Wow. But he did something similar as Perry, except he divided into 5 categories. So each category is a little bit narrowed down, right? Like Perry's anchors go up to 25% yield, which some people would think up to 25%, that's a pretty high risky yield to have as an anchor. Other people might say your anchors should be, 8 to 12% or maybe 8 to 15%. And then from 15 to 25 would be a subcategory, right?
Yeah.
So, Perry, I think he came up with a brilliant system, but you don't have to follow what he designed. You can actually, adjust it to make it your own.
Thought it was an interesting piece of conversation, and I appreciated those comments, in the sense that nobody sees everything the same way. So it gave me a chance to dig into this fund. It doesn't take away from the fact that it does have a high MER, but like you said, Paul, if I'm going to borrow margin at 4.5% versus paying, I think it's 2.3 or 2.2% on the fund here, maybe that's something to consider. But I think, and maybe this is important too, is when we speak here, I don't want some 22-year-old person to see this and go, all of these distributions make my portfolio amazing and it will grow over time. If you're really young, I don't see this as a way to start out.
So what I would say, Darren, is that if you're young in your 20s and something like covered call ETFs gets you motivated to start investing, right? And you can even implement the strategies of having a part-time or full-time job, setting up your automatic deposits, your automatic purchases, and start researching investing, then that's not necessarily a bad thing. But I think eventually they'll probably get to the point where they realize at their age, they could use something like VFV or XE and not have to worry about, managing the NAV erosion or managing the distributions and just let it, happen naturally. Or you could easily be a hybrid investor as well, which is what I have my kids doing right now. They have a bit of both, and they use the funds from their income investments to buy. I have them buying like XEQT and FEQT.
It's interesting because evidence-based, like for instance with Carr and other people who, Mr. Financial, Ben Felix, who obviously have a wealth of knowledge that I would love to have. Maybe I'm working towards it, but it's one thing that stuck out to me recently is covered calls have been around for a while, but is there really enough data to say one way or the other? And I'm hitting on the HDIV idea because here I said, oh, the MER is high. Is it worth it? But do we really know long-term, can a fund be managed like that with 25% leverage and at some point see it not outpacing the growth funds? I don't know. It's an interesting question. I don't know that there's enough research to say one way or the other. And like you said, if you're 20 and you decide that, I don't know, MSTR or some HHIS is the way to go, you're probably going to learn pretty quickly that maybe that's not the case. My suggestion to people is when they ask on Blossom, if they're looking for some advice, I don't give direct advice, but what I'll say is all-in-ones are a great way to get yourself going because your money's working and then you set up the rest of it, the automation and all that. And in the meantime, that's where you need to learn. And if you're not willing to take the time to learn, you may learn the hard way about what you should or shouldn't have invested in. It's not, DIY is not that simple. It's not just like, blindly put money in here and things will work out. I think you do need to learn. I think you should.
Yeah. And if, to be honest, if you're going to make mistakes, it's better to make them at 20, right? Than make them at 60. So, at 20, you still got a lot of time ahead of you. You can afford to make a few mistakes, learn how the stock market works, learn maybe some of the do's and don'ts, what things that you should and shouldn't do. Even just learning how to stomach the volatility, right? My son will check his portfolio and send me a text going, Dad, what happened to MSTE? What's going on? And it's like, but you're 20 years old. You've got 30 years to let this grow. Don't worry about what it did today or yesterday or tomorrow. Like just, keep buying a little bit at a time and let it ride until you make the money. But he is diversified. He's well diversified. Like I said, he's growing XEQT and FEQT to be his largest positions, and just kind of keeping some of the income funds in the background, generating some monthly play money for him to put into XEQT and FEQT. To be honest, the most money he made was buying a penny stock. He bought a gold stock and he's up something like 400%.
Oh, wow.
Yeah. So he's done well on gold. He got into gold at the right time.
Psychology is such a big part of the game. I think that's one of the things I'm learning. We've seen, you and I, since we started doing this, we've seen some pretty big swings in the market. Stuff like I kind of equate it to, like, for instance, like $16,000. That's a lot of money to see your portfolio kind of tank.
Yeah.
and not being able to do anything about it. But if I didn't do the research that I did to have a basic understanding of markets over time, that they eventually recover even from the worst of worst. What's when you did your video with Carr and he developed the 4% calculator that he did, and all financial planning tools are generally based on the worst years in financial sort of, I don't know, maybe history is not the right word. And they always base it on what that was. And that was what, like in the 50s through to the 70s, I think is the time frame.
Yeah, well, I think he was mentioning that 4% rule kept into or took into consideration the Great Depression, like World War II, I think was another one, and maybe the 70s where they had the decade of like stagflation or something. So it took all of those things. But I guess it's smart to take those things into consideration because you never know when history will repeat itself, right?
Well, and I think it lends well to what we talk about all the time, which is you just mentioned it. So like if the worst case scenario is if I need $1 million as my portfolio, what will that look like in the worst of worst conditions if I have to start drawing down on that? Because nobody can predict when it's going to happen. That's part of the problem. And like you said in the past, is maybe a cash wedge would help with that. That's actually something that I'm going to dig into a little bit too. I want to figure out how that would benefit. But that's why they like to look at those timeframes. If you had X amount, would it survive in the worst of conditions? And obviously there's a range in there. You could do really well and have way more money. So it's better to be prepared for the worst case scenario and never see it than not be prepared for it and end up not having enough money.
I love that Carr made his own calculator, right?
I know.
Yeah, isn't that amazing? But I think
it is.
I think he fine-tuned it or something. I think he upgraded it, made a new one.
He did. And for anybody watching, Carr Young Tom, that's his channel. And he came up with a calculator to show drawdown on your account effectively using the 4% rule. Actually, and clarify, he didn't like using the term rule. It's a guideline because it could change. It was developed many years ago, but having a hard and fast rule doesn't necessarily work, but it's a good guideline to use. So he developed this calculator, and we got a chance to play around with it a little bit to see when your portfolio might fail and so on and so forth. And I think that's important. So if there was one suggestion that I would make to you guys is, and no matter how old you are, if you're, well, maybe if you're already retired, it wouldn't necessarily work, but like if you're our age and you're like, how much money do I need? There are calculators out there that will help you figure out what you need based on your OAS, your CPP, your pension, or any other money you're bringing in. That's really important. You don't necessarily need a big portfolio, but you need to know what those numbers are. So if you know the numbers, that helps guide you as to how much you need. And then obviously in your case, Paul, you're kind of showing what you can do when you have X amount of money in a certain circumstance where you're not bringing any more money in, what that income portfolio can do for yourself.
Yeah. And for anybody who doesn't know Carr, you can see Darren and I are both wearing our Blossom t-shirts today. And I'm sure there'll be a link down below for you to join Blossom. It's free. But if you go and look at Carr's posts, I think in the last week or two, he posted a link to his calculator, right?
He did,
and, you emailed it to me, I think the one before he upgraded it. And I put in some numbers. And I think it actually told me in the first year I could take out 6.9%. So I don't think his calculator is based on the 4% rule. It has other inflation points built into it and stuff. But yeah, I would recommend anybody just go take a look at it and see how it works. It's kind of cool.
Yeah, sorry, I should clarify. It wasn't suggesting that it's solely based on the 4% rule, but that's what generated the idea because you had brought him on and you asked him, would your portfolio survive?
I think I stumped him.
And yeah, I watched and you know what? That's what I love about Carr though, is he will meaningfully think about something, and he came up with a solution to that by developing this calculator to open the conversation more broadly. And he's done a few videos now where he talks about, you don't need $2 million or whatever the case may be. Finance is very personal. Figure out what those numbers are and then figure out what the drawdown will be when you go to take that money out. So like you just said, maybe you take out 6% one year, but maybe in a following year, you only need 3%. Very personal, can change from year to year. So yeah. Any final comments?
The last thing I mentioned earlier in the video was just that how I was looking at my portfolio and maybe comparing it to a growth portfolio was the reason why I was getting a little bit down on myself. So the results for me for January, my portfolio was down 1.8%, which is really not that bad when you think about it, right? It's not too bad. Anyways, I did have a high in January of 405,000. but I ended the month at 377. But that's not the 1.8. The 1.8 is from where I started the month. But my monthly income from January of 2025 to 2026 is up 36%. So that's the number that I'm looking at. I went from 7,600 to 10,300. So
Wow.
I think it's doing what it's supposed to be doing. I'm only withdrawing $2,000 out of the 10,300 and reinvesting the rest. I think if I was to withdraw the whole 10,300, I would really hurt my portfolio. I don't think it would be sustainable for very long. But I think I can. What I'm going to try and do is keep doing the 2,000 a month for the rest of the year and see where it ends up.
Yeah, that's really great to see that it's sort of maintaining itself. And like you say, they're unrealized if you don't take out or don't sell any of those positions. Those distributions are still flowing into the account, and how your portfolio grows, whether it's straight growth like price appreciation or from the distributions, total returns always matter. If you guys like this video, make sure you give us a thumbs up and a like. Check out Paul's channel, Better Call Paul. A link is in the video description below. And if you want to see more of the videos that Paul and I have done, you should watch this playlist right here.